Go ahead.
All right. Hello and welcome, everyone. I am Crystal Hawkins-Siska, your president-elect for 2020. Welcome to our final segment, and it's not one to be missed. And before we get started, I wanted to first put out a reminder to all of you out there who haven't done so already. Please be sure to register for tomorrow's event, where we will have key speaker Ricky Mendez, who will start his discourse at 10:30 a.m. tomorrow morning. So please be sure to look out for that link from Gary if you haven't done so already, and click on it and register for tomorrow. Now, as we get into our final section, we want to make sure that we take a moment and thank our sponsors. Our sponsors for today are Georgetta Law Office, of which we will have our own Gary Connolly speaking for his agency.
Good afternoon, all. Unfortunately, John was not able to be with us at the last minute, but we wanted to say thank you on behalf of Georgetta Law for all they do for the association and for Westchester and Putnam counties at large. They are an incredible law firm that handles the whole gamut of from real estate law to wills, et cetera. So we couldn't be more proud and more happy to have Georgetta Law as one of our sponsors for our last segment this day. Thank you.
All right. Excellent. Thank you so much, Gary. Also, too, we want to thank our next sponsor, which is from Fidelis Healthcare Services, health insurance, and that's Anne Marie Atkins.
Yes, it's Anna Marie. Can you, oh, is my video not working?
Oop, we don't see
Okay.
you.
Can you see me?
No, we can't see you.
We can hear you.
We can hear you, but we can't see you.
Yeah, it's not letting me start video. It says the host has asked you to start your video, but I am not able to start my video. I'm sorry. But good afternoon, everybody. Thank you, Hudson Gateway Association of Realtors, for having Fidelis Care part of your Members Day today.
Oh, I lost her.
Hello.
You lost? Oh, were
Okay.
you still there? Okay.
Yes, I'm here. I'm here. Okay. All right. Did you hear me or no?
Yeah, we heard
Yes,
you right.
we do.
Want to say a bit more? Or
Okay.
roll set?
Okay. Thank you, Hudson Gateway Association of Realtors, for having Fidelis Care Members Day. My name is Anna Marie Atkins. I am the community relations rep for Hudson Fidelis Healthcare. Fidelis Healthcare offers low and no cost quality health insurance plans for all stages of life that we do. We have more than 2 million members and 80,000 providers in 62 counties in New York State. We will match you up with the best health insurance plan for your needs. And the exciting part is that we offer dental plans. We're doing the telemedicine. We have case management. So basically it's with the smoking cessation with access to a free therapist to help you quit smoking. We also have one-on-one support for our members on asthma, heart disease, depression, HIV, behavioral health issues, and also we have a baby care program. Due to COVID-19, we're offering all enrollments to be done over the phone. I have provided my contact information at Hudson Gateway Association of Realtors website under insurance, and I will obtain you with a free quote of the health insurance plan that meets you and your loved one's needs. Please feel free to call me at any time to discuss any health insurance plans or any questions that you may have. And open enrollment is starting November 1st to December 15th. And Fidelis Care is doing its part during this national health emergency. We're here to help those in need or lack quality, affordable health and coverage. And also our enrollments are done over the phone to ensure health and safety for all. My number is 845-594-6998. And my email is annamarie.atkins@fideliscare.org. Thank you again for having Fidelis Care a part of today, and I look forward to hearing from you. Thank you.
All right. Thank you so much, Anna Maria. Sorry for mispronouncing your name. Oops.
No, that's fine.
It's all right.
Fine.
And I put a little harmless plug in there for you. I used to actually get Fidelis. I was used to carry that insurance for 3 years in a row. So I was very satisfied with their service. All right. So just putting that out there.
Thank you so much. Yes. Awesome.
All right.
Thank you.
You're very welcome. All right. We want to thank also to our next sponsor, which is Get My CO. And we have Michael Lerner here to speak for his company.
Hi, actually, Michael couldn't make it today, so I'm his brother, Tim Leonard, and along with my wife, Joanne Leonard, we created a company called Get My CO about 3 years ago. I am a registered architect in Westchester County for about the last 30 years, and I have an architectural practice that we found was getting a lot of calls to do legalizations a few years ago. So my brother, Michael, has an extensive background in customer service. And so we asked him to join us and create this company that would solely get people their COs and legalize parts of their homes. So I'd like to thank you guys for having us here today, because you've been a main source of our work the past few years and making connections with all the realtors, because you guys are usually the first people who find out when there's a problem and when they need to get resolved. So we've done over 120 COs in the last couple of years. Most of the COs have been basement legalizations that have all kinds of sets of problems that come along with them, such as ceiling heights, egress, stairs, ventilation. So we are code experts at working with the homeowners to figure out what the problems are. And we have a lot of connections with different building departments who know what we do. They know we're going to submit a good, proper application. And we also have subcontractors we can refer to actually get the work done. So you're looking at a one-stop shop to call us, and Michael handles all the way through. He answers every phone call, every text, every email, so that you're not left in the dark through this process, this sometimes arduous process of getting building permits and COs. So there's always someone there along the way to help you out. We offer a 30-minute free consultation where Michael comes out, does an analysis of the space and tells you what the necessities are to get your CO. And he walks you through the step-by-step process on how to get there. So we welcome anybody to give us a call, and our website is listed up here, the telephone number 914-747-0980. And we look forward to working with you in the future. Thank you.
Thank you so very much. And now our final sponsor from Mr. Chimney is Alexis Martin Leviathan. Is that how you pronounce your last name?
Martin Levitan.
Levitan. Okay. So go take it away, Alexis.
Great. Miss seeing all your faces at the event. This new virtual reality is interesting. So I'm from Mr. Chimney, or the Mr. Chimney family representing. We do all fireplace cleanings, boiler flue cleanings, all heating appliances, gas, oil, fireplace restoration, everything chimney related. We also do some asbestos removal as well. So if you're in a basement and you see some pipe insulation, you can give us a call as well. We can speak to you about that. We are, during the pandemic, we're trying to take all safety precautions. So our gentlemen are fully prepared. And we are also, I'm also a real estate agent with Jefferson Valley Realty. So I know what everyone's going through here through the pandemic, and we can do quick paperwork for closings as well. So if you find anything, any issues with a chimney, fireplace, anything that could be an issue, please just feel free to give us a call at mrchimney.com. You can find us, or 914-777-8200. But we do service Westchester, Putnam, Dutchess County, Rockland, Ulster, and Greene.
All right, excellent. I'll be giving you a call. I need to do my seasonal cleaning before I get started.
As for I'm here.
All right, excellent. And now, without further ado, we will now introduce our featured speaker, which is Maureen McEnroe, regarding tax deductions for real estate professionals. You know, we all love to get money back at tax time. I know I do. And now we're going to get some expert advice on just how to do it. This presentation is going to educate and prepare all real estate professionals to identify and maximize tax deductions and maintain defensible deductions on their return. You'll also learn how to set up tax strategies to maximize after-tax benefits. All right, so now Maureen McEnroe, if you could take it away and teach us what we need to know about our taxes.
Sure. Share. My slides were there and they're not there now. Hang on. That's my screen share.
Screen share is now working.
Okay. Except the slides aren't there. Hang on. They were there a minute ago. Sorry about that. There we go. Okay, so thank you all your sponsors. And as we explained, this is a class that's going to tell you how to maximize your tax deductions. You can see the slides, correct?
Yes, we can.
Good, okay. So the objective of this class, and so this is a class I teach a couple times a year for CE credit. It's a 3-hour class. So I pared it down to just the 45-minute allotment here. So I'm going to move kind of fast to try to get in all the good stuff. Anyway, so this is, how to educate and prepare professionals so that they know what records to keep and what deductions are available to them and how to set up the strategy so they keep more money for themselves. Not playing, here we go. All right, so good afternoon. This is all for real estate professionals or anyone that, if you have a spouse that's a 1099, anyone that's a 1099, these strategies will work for them as well. So I want to preface this to say that I'm not an accountant. I do have an MBA and I'm a chartered financial analyst. My background is in business planning. So analysis is my forte and part of my strength as an analyst is in forecasting and planning. And that's what you need to be able to forecast and plan to be able to create your tax strategies. So what's in your pocket? It's not what you make, but what you get to keep that really matters. This course is going to help guide you through what is tax deductible, what records you need to keep, and how to maximize your deductions. So before 2017, we hadn't had tax reform since 1986. So it's a completely different gig economy, and we were really due. So starting in 2018, we all became subject to the changes that were embedded in the Tax Cuts and Jobs Act, which was signed by President Trump in December of 17. It reduced tax rates, gave us higher standard deductions and higher child tax credits, but that was offset by a bunch of deductions that we lost. Deductions that we lost, for example, the personal exemption of $4,100, the home equity loan interest was lost, moving expenses was lost, casualty and theft losses are no longer deductible unless it happens in a disaster, a national disaster, and job expenses for employees. So 1099s pretty much were left alone, and we actually got some significant benefits in reform, but employees lost a lot of deductions. Subsidized parking and transit for employees was lost, tax prep fees for employees was lost, a bunch of miscellaneous deductions as well. This is one of my favorites. Donations to colleges in exchange for athletic event seats. That wasn't a donation, that was just it. That was buying tickets in advance and trying to make it a tax deduction. So that's no longer part of it. And for us, meals and entertainment used to be a 50% deduction. They've maintained the meals part, but now the entertainment is not allowed. But who defines what's entertainment and what's education? We do. So I'll give you some strategies later on how to handle that. So the tax reform impact on real estate. One of the biggest things that everyone talks about is the $10,000 limit on SALT deduction. That's your state and local taxes. So if you live in an area like New York, like most of HDR is, your average $400,000 house is $10,000 or more in taxes. It's probably $12,000 in taxes. So most of us lost a significant amount of deduction on our homes with tax reform. They lowered the limit on deductible mortgage debt to $750,000 from $1 million. And that's just the mortgage part, not the value of the home. They repealed the personal exemption, which was $4,100 for the filer and the spouse, which was pretty much offset by the higher standard deduction that they gave us. And this is one for business owners more. They raised the 179 expensing limit to $1 million from $500,000. And I'll explain what a 179 limit is later on. So the standard deduction was raised initially to $12,200 for individuals, $18,350 for head of households, and $24,400 for married. They have upped that every year. So now for 2020, which October 15th was the last date to file for 2019. So from this point forward, I'm going to be addressing 2020 taxes and the numbers involved in that. So for 2020, the individual is 12,400. The head of household is 18,650, and the married filing joint is 24,800 is the standard deduction now. So driving, when they did this, they drove really more people to take the standard deduction versus itemizing. And the federal government also indicated they thought that the tax benefit of ownership versus renting might have been taken away for a lot of Americans. I don't think we've seen that in the real estate market, but that's something that they proposed was going to happen. Moving expense deduction was taken away. They did retain, so they tried to take away the 1031 exchange or part of the value of that, and NAR fought very hard to retain that, and they did retain all the 1031 exchange deductions and capabilities, which is important in our business, especially for investors. One other thing for investors, they did increase the carried interest expense to a 3-year holding period. It used to be 1 year for capital gains. It's now 3 years. Charitable deductions and contributions are still deductible. Medical expense, if it's 10% or more of your adjusted gross income in 2020, it is a deduction now. It used to be 7.5% before that. And estate tax exemption doubled from 5.49 million to 11.4 million. So one of the biggest things for real estate agents that was put in this year was something called the qualified business income deduction. You'll see it referred to as a QBI. Since corporations now are down to a 21% tax rate from a 35% tax rate, Congress felt that small businesses, LLCs, and individuals that are operating for their own sole proprietorships should also get some sort of a benefit. What they put in place is it's a personal deduction for pass-through entities, income on pass-through entities. So we are all 1099s are essentially pass-through entities, unless you have a C Corp, and then you're not. You can't do this in a C Corp. So if you can deduct 20% of your AGI of your business income earned if you have taxable income of less than 163,300 as a single and 326,600 couples filing jointly. And this can be taken in addition to your itemization or your standard deduction. Either way, whichever way you choose to do your taxes, you get the QBI deduction. So to give you an example, this is just a chart that shows it a little bit better. If up to 163,300 for individuals gets the full 20% QBI. And same head of households the same as individuals, and for families for married 326,600. There's a range of incomes where they start to phase out the QBI, but you'd still get part of it. So from 163,301 to 213,300, you can get part of that 20% deduction. And there's a very complicated formula that your accountants can work over with you, sort of beyond the scope of what we can do in this class. And then for families, for married people, 326,601 to 426,600 is your phase out range. So if you make more than 2013, 301 as an individual, you don't get the QBI at all. Okay, does that mean that you're boxed out? No. So if you look at the chart on the right-hand side, there's a family that made 449,751. If they took the standard deduction, they really would not be eligible. They'd just be at they'd just be within the range of losing out on the full impact of QBI. If that same family were to take, put $27,950 in a SEP, they'd lower their income enough, and after their income's lowered into the point where they would get part of that deduction, and then when you take the standard deduction away, they get down to 392. So they're going to get a good chunk of that. They'd still be in the phase-out range, but they're going to get a good, good ability to deduct some of that. I think as individual proprietors, we can put up to sometimes like $55 million in a SEP. So if you're in a range where you're just over that, and if you put enough money in a SEP to get you down under that 326, you'd be able to get the full 20% deduction. So the federal government looked at who took QBIs in 2018, which was the first year they were allowed to. And they came back with a statistic that 900,000 tax returns that were eligible for a QBI deduction did not take it, which is kind of scary because it's a lot of money. If you're making 100,000 and your AGI is 80,000, 20% of that is $16,000 deduction. That's significant. All right, so there's some really complex concepts in this class. Consulted with tax professionals, tax publications, IRS documents, and other publications. And this class is an overview of what's allowed, what's not allowed as real estate professionals, so we can legally lower your tax burden and put more money in your pockets. So as an independent contractor, your brokerage gives you a 1099 that represents the revenue side of your equation. But it's up to each and every one of us to accurately track and maintain expense records so you can adequately completely utilize all the legal deductions available to you. So hopefully at the end of this class, You'll be able to know what records you need, what documents you need to monitor, and what deductions are available to you. So, just as an aside, those 9,000 people, that 900,000 people that didn't take the QBI, the IRS did not call them and tell them that. No one's ever going to call you and tell you. The onus is on us to know what's out there, know what's available to us, and to maintain our records. So don't be overtaxed. You want to use the tax code to your advantage. The average person does underestimate their deductions and overpay taxes significantly. And do you want to tip Uncle Sam? My guess is not really. So just a couple of definitions before we jump in. An exemption reduces your taxable income by the amount of the exemption. A lot of exemptions were eliminated in tax reform. Deduction reduces your taxable income. The tax credit is a dollar for dollar reduction in your actual tax bill. So tax credit is always more valuable than a tax deduction. The standard deduction is the portion of income not subject to tax that reduces your taxable income. Gross income is the revenue you receive from all sources. Adjusted gross income is your gross income less your deductions. And your taxable income is your adjustable gross income, minus deductions and minus tax credits. So this is just a quick chart to show you that credits are always more valuable than deductions. Same person on either side, $100,000 AGI, their tax deduction on one side and tax credit on the other side. So the taxable income on the deduction side is only $90,000. Then at a 25% tax rate, they'd be paying $22,500. On this credit side, $100,000 at 25% tax, your tax you should be was $25,000, but you have a tax credit, which is a dollar for dollar reduction. So that person's only paying $15,000. So the Internal Revenue Service, right? The picture says it all. It's theirs. They get to make, they make the rules, they get to change the rules as they see fit. We just have to learn how to follow the rules to maximize our deductions. So the IRS indicates licensed real estate agents, real estate tax tips. Most real estate professionals operate their business as a sole proprietorship. This means you're not someone's employee, you haven't formed a partnership with anyone, and you have not incorporated your business. We are statutory non-employees. So licensed real estate agents are statutory non-employees and are treated as self-employed for all federal tax purposes, including income and employment, if 1, substantially all payments for the services as real estate agents are directly related to sales or other output, not number of hours worked. Your service is performed under a written contract, providing they will not be treated as employees for federal tax purposes. That's the agreement you sign with your broker every year. And this category includes individuals engaged in appraisal activities for real estate sales if they earn income based on sales or other output as opposed to hours worked or salary. This means essentially you're an independent contractor responsible for paying your estimated taxes quarterly and filing your own annual returns with only a 1099 from your broker, indicating the commission that you've earned in a given year. IRS Publication 334 states, you're a real estate dealer. You are a real estate dealer if you are engaged in the business of selling real estate to customers with the purpose of making a profit from those sales. Rent you receive from real estate held for sale to customers is subject to self-employment tax. However, rent you receive from real estate held for speculation or investment on your own part is not subject to self-employment tax. As a general rule of thumb, for agents and brokers earning up to $100,000 a year, every dollar deducted from your taxable income will save you roughly 50 cents in taxes. This is assuming a 24% federal tax income, 15.3 in self-employment taxes, and 8.375 in state and local taxes. For those lucky agents making over $100,000 a year, your deductions are worth a little bit less than 50 cents on the dollar, but probably approaching 40 cents on the dollar, and still well worth our time to maintain the records to take those deductions. So according to the IRS Code Section 162, any expense of your real estate business is deductible if it is ordinary and necessary, directly related to your business, and a reasonable amount. So there's no upper limit on your deductions as long as they're reasonable, and you can't deduct more than you spent. If you have real estate earnings of $12,000 and you spend $15,000 on dues, advertising, buying leads, and other real estate business expenses, your deduction is limited to the $12,000 earned. Good news is that in most cases that $3,000 is not really lost. It becomes something called a tax loss carry forward that can be used in future years against future income. Again, if you're a first-time broker, first-year broker, you might make less than you spent because you were trying to build your business up. But if you're doing this a long time and you're still spending more than you're making, you need to talk to your broker because you really need to reevaluate what's going on. So doing a quick back of the envelope calculation, I'd like to quickly demonstrate the value of a deduction. So this hypothetical real estate agent is a single 50-year-old person. They earned $100,000 and had business expenses of $27,000, of which 24,000 was deductible. We assumed a 24% federal rate, 8.375 local, and 15.3% self-employment tax. Take the same agent and introduce the 4,000 this year in itemized deductions. Instead of this, and 24,000, I'm sorry, in itemized instead of the 12,400 that they would be able to take as an itemized. So by using their itemized deductions, this person would reduce their taxable income by 9,440. And assuming the same, the tax rates above, they would have saved 2,227 in federal taxes, 777 in lower state, and 1,310 in lower self-employment taxes, for a difference of $4,314. For this example, we ignore the 50% deductibility of self-employment tax in both cases, but we'll add that in back later on. This is just a chart showing what I said. Some people are more visual learners. So the first column is standard deduction. The second one is itemized deduction. So, the expenses are 27. They weren't all itemized. They weren't all deductible. So let's say 24,000 was deductible. So the left column is taking the 12.4 standard deduction, shows the 20% QBI deduction for that person, getting their taxable income down to 70,080. The person that itemized, because their deductions are much higher, their itemized pass-through QBI is a little bit lower, but they get their taxable income all the way down to 60,800. This is the same person who spent that 27,000 expenses. They just spent the time to keep the records so they could do an itemized deduction. So you see the difference there is 43.14. That's almost another closing, guys, if we keep good records and itemize. So the Tax Jobs Cut and Job Act, Section 199A, is known as the Qualified Business Income Deduction. This is a very significant tax cut, and it's a tax cut from our adjusted gross income. Anyone, a real estate sole proprietor, which is anyone that doesn't have an LLC or an S Corp, any individual person is considered a sole proprietor. Real estate investors, REITs can take this, states, trust, S Corps, LLCs. C Corps and certain specified service or trade businesses are not eligible for this QBI. Realtors, 1099 realtors are definitely eligible for this. Again, income limits, 163.3 for single, phases out at 213.3. 326.6 for married filing joint, phases out at 426. So there's actually a complicated thing that your accountants have to look through. Deduction is lesser of 20% of taxpayers' QBI or 50% of what would be W-2 wages in a phase-out range. So this is a case where your neighbor says, I'm going to sell my house myself because I can. What do we tell them? We say you always use a professional to sell your house. So in taxes, always use a professional accountant to do your taxes. Don't do them yourselves. But they don't know. They don't follow you around every day, and they don't know what you're doing. So you need to bring them the information, the data, and the paperwork to justify all your taxes. But let the professional do all the heavy calculations and sign their name on the dotted line. So banking and tax planning is an important thing. As a new or even experienced agent, you're getting a big check, and how excited is it? You work for it. You held their hands. We become, sociologists and psychologists, and in addition to realtors, I think the definition of full service has expanded greatly, especially what's going on with in the last couple of months. So you get that check, and your eyes glaze over with how you're going to use that money. Let's just take a step back and look at how you should be looking at this check. As an independent contractor, most accountants recommend filing quarterly taxes. So you can't take any of these deductions till the year end when you file the fiscal year taxes. But the estimated taxes are calculated off your anticipated gross revenue for the current year. In order to facilitate this, I recommend to take each check and deposit it into two separate accounts. Open a separate savings account that's not linked to your checking account. If you're in the 24% tax bracket, immediately deposit 24 to 25% of each and every check into the savings account. This will be the account from which you'll be paying your quarterly tax payments. So when a time rolls around for you to pay, you're not scrambling to find the money to pay those taxes. And one piece of advice as an agent, don't count that check until the deal's closed. Deals are falling apart for crazy reasons. And if you spent that money or earmarked it for a vacation or an event, you not only lose the deal, but you lose the vacation as well, which is doubly upsetting. So self-employment tax, employees pay a 15.3 FICA, Social Security, and Medicare tax. This is split evenly between the employer and the employee. So the employee's paycheck is reduced by 7.65%, and the employer pays the other 7.65%. And that's how you get Social Security and Medicare when you age into it or when you're eligible for those special services. Self-employed workers are given credit for Social Security and Medicare contributions via the self-employment tax. So these workers are included, even if you're self-employed your whole life, you're included in these two important safety net programs. The self-employment tax is 15.3% of 92.35% of the independent contractor's net income. Where that 92.35 came in, I've never been able to hunt down why it's not 15.3 of 100%. However, in this case, the government makes a little bit attempt to be fair. Given that there's no employer with which to share the expense, the IRS allows independent contractors to deduct 50% of their self-employment tax. So you're paying 15.3, but half of it, 7.65, is a deduction for you. And that's done in your Schedule SE that has to be submitted with your taxes every year. So this is the meat of lists of deductions that we can take. And I do have a list. I do have this list of deductions that I can email to people that are interested after the class. Anyway, so for real estate professionals, one of the biggest deductions is our car and truck. So if you're really good at keeping records and you want to maintain all of your car expenses and figure out your annual deductions, how much you spend for gas, oil, car washes, repairs, maintenance, tolls, everything except, everything except mileage. That's one thing. That's called the total expense method. The other one, and it's one of these two, you can't do expenses and mileage, is one or the other. Or B, you can track how many miles you've used your car for business and use the standard deduction for mileage. It was 58 cents in 2019. It's going down to 57.5 cents in 2020. Note that the mileage that you use to drive to and from work is not deductible. Only the mileage used in previewing, showing, everything else you do for real estate is, but back and forth to the office is considered part of doing business. It's not a deduction in mileage. Office expenses, if you have a home office, you may be able to deduct rent, utilities, and that you spend for that office. Renters or owners can take this deduction. Business travel, if you go out of town for business, you can deduct airfare, transportation costs, hotel, lodging, expenses, 50% of meals while you're away. If you go for a conference, a seminar, any of those things, they're all, you can deduct them. So if you take a client out and have meals and entertainment, if you take a client out and have a serious business discussion before, during, or after the meal or event, you can deduct 50% of the cost of that meal or entertainment as a legitimate business cost. Entertainment deductions went away in 2018, but food at open houses is considered 100% deductible, not 50%. So I said before, never entertain, educate. How you define something is important. So if you take a client and you take them to dinner and you want to put this in as a meal, that's one thing. You could also put it in as an education session. You provided food at an education session with this client, and education is 100% deductible. Depreciation. Property you buy and use for business can be depreciated over time. Items like cars, property, computers, your office furniture can all be depreciated over time. The IRS Code Section 179 allows an agent to deduct the full price of business equipment, furniture, or other long-term items purchased for your personal use in a home or broker's office in the year it was purchased, as opposed to deducting it over time. They did raise the limit to $1 million from $500,000. So this is an area that you really need to talk to your accountant about as well. My son is in real estate, and he wanted to buy a car and deduct the whole thing up front because he made a fair amount of money in a particular year, and his accountant said she wasn't comfortable doing that. So even though it's allowable, she felt it was something that might raise a red flag, and she wasn't comfortable doing it. But if you're buying, especially if you're a broker and you're buying significant business equipment and you have a lot of revenue that year, and you might not have the same level of revenue that year, you can make that 179 election to deduct all that capital property in that 1 year. So supplies are business items that you use in less than a year. So like paper, ink, toner for cartridges, postage, paper clips, all that kind of stuff, software, internet, phone services, that's all considered supplies, and that's all deductible. Legal and professional services, any fee you pay to any accountant. For employees don't get to deduct tax prep fees, but we do. Lawyers, consultants, if you do professional pictures for your listings, all those things are deductions for you guys. Insurance that you buy just for your business is deduction. So the business, if you pay for business liability insurance, E&O insurance, that is a deduction for you. If your broker pays for it, it's a deduction for your broker. So you have to actually incur the expense to take that as a deduction. You might be able to, if you're home office, you can deduct part of your homeowner's insurance. Self-employed people who purchase their own health insurance, that's a 100% health deduction for them. If you're married to someone who buys the insurance, then they cannot, and they're an employee somewhere, then that is not 100% deduction for them. It has to be run through their through the employee side, not through the 1099 side. And actually, I had someone at a class say, "My husband pays for it. Can I write him a check and then take the deduction?" And the accountants would say, "No, you cannot do that." Okay, medical expenses when they reach 10% of your income, that's a deduction as well. Health savings account contributions can also be deduction. This is another big category for realtors. It's marketing and advertising, and it's frequently underreported. So any funds you spend on websites, mailing lists, newspapers, or online advertising, just sold cards, flyers, postcards, any promotional materials, logo clothing, if you order pens or send seeds to clients, all that stuff, well, that's all deductible at 100%. Like almost every week, in your office, someone comes by and asks you to sponsor a golf outing or a golf hole. Keep track of all those things because it's so easy. You say, yeah, I'll do it. And you give them the check and then you forget. And, you do that, 10 times a year, and that's $1,000 deduction that you've missed. So make sure that you keep, records of all those things that you're advertising in. Business gifts. Many agents can hand their clients a gift at closing. Each gift can be deducted up to $25, and that's per client per year. So if you're working with investors that might be doing 2, 3, 4 properties with you a year, one gift of $25 is deductible per year. So that $100 or $200 restaurant gift certificate you're giving them is not fully deducted. Here's another tip. You don't want to gift someone, you want to advertise. So if you can come up with something that is a piece of advertising as opposed to considered a gift, it would be 100% deductible. I know at many of the HDR and conferences that we go to, Cutco Knives is there. That's a very interesting gift. You can order knives that has your name and phone number and your company name on it. And that's considered, you give that to someone as a closing gift. It's a nice closing gift. And the Cutco knives are, very high end, but it's not a gift, it's advertising because it's got your information on it that they can share with other people for marketing purposes. I think there's companies out there that will do bottles of wine that have business labels and whatever on on it for you. So, you can be creative, but if you want to advertise as opposed to gifting, you can you really use those deductions. So desk fees, not all brokers charge them. Or technology fees, but if you are charged those fees by your broker, then those are deductions as well. And all of our professional dues, fees, subscriptions, NYSAR, all the real estate organizations that you pay for, every particular designation you have to pay fees for, your e-key, all of that, biannual license renewal fees, that's all deduction for you. And any print or online magazines or periodicals that you advertise in, that's all a deduction. Education. So classes you take in person or online that are necessary to maintain your license or further your education, the cost of these classes are fully deductible. Unfortunately, so the 22.5 credits we take every 2 years is a deduction. It's important to note that the cost of obtaining the sales agent or broker's license is not a deduction. The IRS has determined that you weren't an agent then, so you couldn't take the deduction until after you took the class and became the agent. So retirement plan contributions, this can be a very good piece of our tax strategies. If you make a contribution to a retirement plan or 401k or SEP, personal K, all those contributions are nice deductions, and it's dollar for dollar. And any interest on business loans or anything you paid for your credit cards, that's all deductions as well. Brokerages have several other tax deductions available to them, like office expenses, rent, cleaning and maintenance, utilities. If they pay referral fees or commission rebates, franchise fees, all of those are deductions for brokers. And to the extent that an agent pays part of these fees, if the broker rolls some of those fees down to the agent, then the agent can take the deduction on those fees as well. So if you need help, why don't you hire your kids? I'm not talking about breaking any child labor laws, but if you need help during your busy time, you can hire your minor children. The wages you pay the child is deductible by you and taxable to your child at a much lower rate. Wages paid to children under 18 are not subject to payroll tax unless you operate as a corporation. So when my children were living home and teenagers and driving, they would go out and put my open house signs out for me, and I'd pay them for that. I mean, they were going to get money from me anyway. I might as well make them work for it. So, record keeping, documentation is your friend when it comes to deductions. The devil's always in the details. The IRS has very strict terms and conditions for deductions, and all the burden is on us to provide the proof if we get audited. The IRS wants to see the person, place, the cost, the purpose, and the date of your expense. For car expenses, if you're doing the total car expense, anything costing $75 or less, you only need to mark down what day and time you spent it and what you spent it on. Anything $75 or above, you need to have a receipt or a record of it. And we need to keep our records and receipts for 7 years. The IRS, if they don't like something they see with you today, they can go back and ask you for 7 years worth of taxes to review and documentation for those 7 years. So separate accounts. Some agents use a separate checking account and credit card for their real estate utilization. I think that's a great idea. It really helps with record keeping at the end of the year. Deposit all your commission checks and pay all real estate expenses from that account. This makes for very simple record keeping and tracking at the end of the year. Your car and home office expenses should not be paid out of that account. Budgeting and saving. If you maintain a separate business account, pay yourself a salary of no more than 50% of gross or 60% of the net income. The remaining money that's left in that business account, you pay for your business expenses, your taxes, and then it leaves you like a little bit of leeway for some months when your commissions might be on the lean side to be able to pay your expenses. So how do you track your mileage? So if you have an appointment monitoring system like Outlook or Google Calendar, you can use those to notate mileage for each trip in your car. What I recommend doing is to track and record your mileage daily in a little book or something in your car, or on a weekly, and on a weekly or monthly basis, take all those trips and transcribe them into an Excel spreadsheet or whatever you're comfortable, however you're comfortable monitoring them. And when tax time hits, all you have to do is add up all those categories, and you're not going back, 9 months or whatever to try to figure out how many miles you drove. So the IRS requires a 3-month log to prove auto deductions. However, our business can be very seasonable, so only tracking your mileage for 3 months might underreport your actual mileage you've logged. So H&R Block and several other accountants have developed some really nice worksheets that can be used to track your expenses. And we have a set of handouts that I'll have to figure out how to get to you, but we have a couple of examples of those spreadsheets in those handouts. So for 2020, mileage deductions decreased a little bit. 2019 was 58 cents. It's going down to 57.5 cents in 2020. So you can also, I don't know if you're aware of this, but you can also deduct mileage for medical reasons and for charitable. So if you're on, some organization or board of something and you're doing a lot of driving for charitable purposes, for every mile that you drive for those charitable purposes, you get to deduct 14 cents a mile as a tax deduction. And for back and forth to the doctor for you or for someone that you're responsible for, it's 20 cents a mile deduction. So that's changed. It changes every year. There's a bunch of things that go into how they determine the mileage deduction every year. The biggest input into is the cost of gas. So when gas prices are high, our deductions are higher. When gas prices go down, our deductions go down some. So with those of you with a more technological bend, there's a bunch of apps out there that are available for free or for purchase that track mileage and or expenses. I'll go over a couple of those apps. And in the 3-hour class, we go over the apps a lot, but this is just sort of naming them now. So for tracking business mileage, there's something called Concur. It used to be called Mile IQ. It was a free app. Then the Trip Log GPS mileage tracker. That was not free. Something it's called Auto Miles now. It used to be called Magical Miles. You can track up to 100 miles for free. And then something called Everlance. And then QuickBooks Self-Employed is $4 a month, and they have a decent mileage tracker as well. So a lot of these, the way they work is you plug your phone into your car, and when your car starts going about, say, 3 miles an hour, it automatically triggers these apps, and you just swipe and write in. You can write in business, pleasure, medical, or charitable. There's usually 4 options in a bunch of these apps. So how do we manage our receipts? So the tried and true old-fashioned method of saving was to put them in a shoebox, right? And then when the taxes come out and you have to figure them out, you will get a big bottle of wine or something, pull out the shoebox and go through receipts and pull your hair out. Accountants really don't recommend that. They really recommend sort of keeping better control of your expenses and all your receipts, or as it happens, as opposed to the end of the year. If anyone ever picked up in December, picked up a receipt from January, and you look at it and go, I can't see what that says. The ink is gone and it's just useless now, right? You kept the receipt, but you can't read it. So there's a bunch of apps out there that help you categorize and save and scan your receipts as well. It's not exhaustive, but it's a good representation of some of the ones that are out there. There's one called Neat Receipts, another called Certify, Shoeboxed, Expensify, and then Verify. And then there's 2 for the price of 1. Something called Hurdler. It's an automatic business mileage expense and mileage tracker. So it tracks all of your mileage, your expenses, your income streams, your tax deductions all in real time. These can all be converted to QuickBooks or sent to Excel, whatever system, whatever financial system or accounting system you use or your accountant use, you can send all these reports to them. They say Hurdler's advertising says on average, people find about 5,600 in tax deductions by using their system. Excuse me. So the home office deduction requirement. So to be eligible for deductions, the IRS indicates that part of your home must be used for one of the following. One, exclusively and regularly as your principal place of business. Sorry. Exclusively and regularly where you meet and deal with clients in the normal course of your trade or business. A separate structure used exclusively and regularly in connection with your trade or business, not attached to your home, or on a regular basis for certain storage uses. This space is not supposed to be used for any other purpose. I did have a long conversation with my accountant asking her if I thought, because so many people are working at home now because of COVID, if the IRS was going to loosen the standards of what they considered a home office. And she said they talked about it, but there hasn't been nothing has come down to say, yes, we're going to loosen the home office requirements this year. I mean, it can happen, I just don't know it. So part of home office deduction, your mortgage interest, your casualty losses, I'm sorry, I have to take them out now because of, unless it's part of a disaster. Property taxes, repair, depreciation, maintenance, everything that costs to run your house throughout the year. A portion of that can be deducted in home office deduction. So a rough way to calculate the deduction is to take the total square footage of your home or condo and divide that by the square footage of your home office. For example, if you have a 2,000 square foot home and your office is 150 square feet, your office is 7.5% of your home. You can deduct 7.5% of your total cost to run your home for the year as your home office deduction. So it can be sizable. So say this person's home expenses are $25,000 a year and their home office deduction would be $1,875, which would save about $900 in tax savings. So business structure. Many real estate agents and brokers operate and file taxes as sole proprietors. The self-employment tax we discussed earlier is due under this taxable entity. Some agents opt to form an LLC or an S corporation, which reduces your self-employment tax liability and also gives you personal protection against anyone suing you or trying to attach your assets. They can only attach the assets of the corporation. An S corporation allows you to reduce self-employment taxes by splitting salary and dividends. This can be important as well. So many accountants will tell you you can't say 100% dividends and no salary because the IRS would look at that as a red flag. But most accountants will say like 50-50. If you're making $100,000 a year, you pay yourself $50,000 in salary and $50,000 in dividends. So you're only paying self-employment tax on that $50,000, not on the whole $100,000, which can be significant savings. There are some regulatory things you have to do to be an LLC or an S corp. There's a filing you have to do every year, and some fees you have to pay, and you have to pay yourself a salary. Like most people do it through PayPal, just to pay themselves a salary at the end of the year, so that it's completely legal the way the IRS wants to see it. So if you pay, as I said, you pay self-employment tax on only part of your income, you have to designate a reasonable amount of your income as wages as opposed to distribution. I guess if you look at New York State franchise, it does cost something to be an LLC or an S corp. With revenue of $0 to $100,000, I think you have to pay a $25 franchise fee a year. And if your revenue is $100,000 to $250,000, you pay $75. So it's minimal, but there are some other things you have to do, as I said, about setting up a payment system, et cetera. So if your taxable income was $61,000 and we assume 75% income and 25% distribution, which is very conservative break, this could save the agent about $2,100 in self-employment taxes. So I'm calculating the self-employment taxes on $45,750 instead of the $61,000. That more than offsets that franchise fee. Estimated taxes. This is sort of the crux of how we figure out how much we need to put away for next year. So as an independent contractor, the total amount of taxes due is greater than $1,000 for the year. You're actually obliged to make quarterly estimate tax payments to the IRS. Our federal tax system is what's called as a pay-as-you-go system. So if you wait to pay the entire amount until you file your annual taxes, the IRS can at any point in time charge you late fees, penalties, and interest charges. Now, this usually does not happen, but if you get audited or if they find some sort of discrepancy, they can go back and say, well, this was due in this quarter, there was 3 quarters that you missed, this is your penalty and your interest charges. To estimate taxes, you need to kind of figure out your 2020 commissions and your 2020 total business expenses. Take the commission anticipated and subtract the estimated expenses to come up with your estimated net income from real estate activities. The IRS very generously gives us the tools we need to calculate our taxes. So their publication 505 and Form 1040-ES has a 12-page tax estimation worksheet that lets you calculate each step of what you need to pay taxes-wise. So in the 3-hour class, I go through examples of how your taxes need to be deducted. We didn't have the time in this format to do that. If you want to take next time, 3-hour class is up if you need help going through the steps. But it's essentially like a 10-step process where you go through revenues, expenses, deductions, whatever, and you come up with, because based on your federal taxes, you're going to owe, say, $10,000 for 2020. You're supposed to pay $2,500 each of the 4 tax filing periods, quarterly tax filing periods, not 10,000 in April 15th of 2021. Benefits of tax reform, just quickly under the old system. If you had net commission income of 45,000 and salary of 45,000, your personal exemptions back then was a family. This is a family of two adults, 2 children, and their itemized deductions. That family would have taxable income of about 55,400 and pay 73.58 in taxes. There was tax credit for children back there of only 1,000 a child, and they're after tax, they would have been paying 53.58. Under reform for a family of 4 making this kind of income, net commission, I have the same incomes there. The 20% QBI that's only off the person that makes, not salary people don't get it, only the net commission income gets it. So 9,000 QBI plus a standard deduction, which is higher. Their taxable income is a little bit higher, 57,000, but because the tax rate's lower and the tax credit for children's higher, the same family under tax reform is only paying 24.59. So we're paying almost half of what they were paying under the old system. If you're a high earner, the savings are not as significant. So quarterly tax due dates, the first payment is due April 15th. Second payment is due June 15th. Third payment is due September 15th. And the fourth is due January 18th of 2020. It's usually the 15th, but 15th in January is Martin Luther King Day. So if it's a weekend, actually, I think it's like a Saturday, and then the Monday is Martin Luther King, so it gets bounced to the next non-holiday day. There's a couple of important tax deadlines. Last chance to make your IRA contributions. January 15th is when the 4th quarter of that previous year is due. Your 1099s have to come out to you by end of January. Bank institutions have to send them by February 15th. Your flexible spendings, you have to make your use it or lose it by March 15th of the year. April 15th is tax day, and then the next quarterly payments. October 15th is the last day to file for that given year. But you do remember, even if you're not ready to file April 15th, this year it was July 15th because of COVID, you have to file an extension. If you fail to file an extension, they can still fine you for late fees and interest. As long as you file the extension, you have till October 15th to do taxes that year. So audit red flags. Failure to file quarterly taxes is a big one. Unreasonable deductions. If you're making 100,000 and deducting 75,000, people can't usually live off 25,000. The government might see that's a little bit spurious. Unlikely home office deduction. If you live in a trailer, you're trying to deduct a huge amount. That's probably not a good idea. Deductions unlikely for your income level, and sloppy mileage reporting can be some significant red flags. So that's it for, can I get out of the share? Questions?
So Mary will be asking those questions in one moment.
Sure. So this Q&A at the end that you see in my slides was, I have a series of questions at the end just to test how well I did for teaching the class, but a bunch of them are probably Q&A that's in my deck is what we didn't cover all that level of detail in this for you, just a bridge version.
The first question we have is, are membership and education still deductible?
Yes, they are, 100% fully deductible.
Okay, great. Then we have, someone says, I'm a new realtor, expenses, but no income yet. I already have an S Corp set up from a previous career for QBI and other tax purposes. Is it better to pay for expenses and get paid for real estate activities through an S corporation rather than as a sole proprietor?
Okay, so if you don't have any income yet, so you until you have income, it's irrelevant. But when you have income, it would be better, especially if this is your full-time job and you expect to have significant income coming, it would be better to be paid through the S Corp as opposed to individually. And then when you have income, you can split your income between income and dividends and only pay self-employment tax on that actual income. But keep track of everything you've spent this year expense-wise, because if you spend $10,000 to get up and running, but you had no income to report against this year, you can put that in what's called a net loss carry forward. net operating loss carry forward, or NOLs. You'll sometimes see them written, and then you can put that against future year's income to take those deductions, because you spent the money. It's only fair you get to deduct it.
Okay. I have another one. I have many friends that are business owners. How can I tell them about QBI?
Yeah, so if your accountant has not taken QBI for you in the last 2 years, you need to fire the accountant, because that is a huge deduction for people that are 1099s or self-employed. If your friends are C Corps, they do not get that deduction. They do not get a QBI. Or if your friends are in certain businesses, like lawyers don't get it, medical professionals don't get it, financial and insurance professionals don't get it. There's a couple of precluded industries that are not allowed to the QBI.
Okay, and this was, sorry, should I be using a CPA that specializes in real estate versus general CPA accountant?
You know, most accountants are capable of doing everyone's taxes, but you know, some people do specialize in what, it doesn't have to be real estate per se, but a 1099 person who understands what sole practitioners are, you know, what deductions are available to them. You should definitely be using someone like that.
Okay. Someone's asking if you could repeat what the expenses of the retirement are.
Expenses. So retirement is a deduction, not an expense. So it's you know, like any retirement money that you put into an account, like a 401k or a SEP or whatever, that's a deduction, because it's not unless it's a Roth IRA, which is put in after income. It actually is not a deduction. It lowers your taxable income. So if you make $100,000 and you put $20,000 into a SEP, your taxable income's only, it starts at 80 before you have any deductions or standard deduction.
Okay.
Or QBI.
Here's one. If someone's a part-time realtor with a home office, can I deduct rent on the room that I use for business if I live in an adult community for 55 and over?
Okay, so if you technically you're supposed to have a room that's dedicated just to your, it doesn't have a bed, doesn't have a bunch of other things in it. It's not, you know, it's not your kitchen with a desk in it. If it's a room dedicated to your home business, regardless if it's in, you know, the tundra, as long as it meets the criteria that the IRS says, then yes, you can deduct it.
Okay. If we received unemployment benefits this year because of COVID, will that affect our total income?
Absolutely. So, you know, the $400, $450 a week that you got from unemployment is not a lot of money. So a lot of people elected to not have taxes taken out and took the whole $450 a week. So to the extent that you didn't pay taxes on that, you'll add all that up, you'll get a 1099. Well, you don't get it. You have to go on to the unemployment website and print out the 1099. They don't mail it to you. So you have to go on and print that out, and that is part of your income. If you did elect to have them take some taxes out, you just print that out from their website at the end of the year and see how much taxes, because your accountant's going to have to add that back as income and figure that out for you.
Okay, great. And we have a question from Noreen. Is the expense for a real estate coach tax deductible?
Yes, because it's something that you're doing to further your education or do better in your job. So it's deductible. You know, keep records, you know, just keep records.
Okay. The quarterly estimated taxes, when does it start to matter? Someone say, I was not planning on becoming a sole proprietor freelancer this year, made very small amounts of money on the books here and there, not from the same industry or with predictable regularity. I also only became an agent this month. Would estimated quarterly taxes already be expected from me based on the scattered income?
Right. So technically, if you're going to owe $1,000, which is not a lot of money, if you're going to owe $1,000, you're supposed to pay quarterly income. But what the IRS looks at is they look at this year versus last year. So for example, if you had no real estate income last year, then you don't really have to pay quarterly taxes this year. But if you do 100,000 in real estate income this year and then opt not to pay quarterly taxes next year, they go back and say, hey, you guys, you made money, you're going to owe taxes, you're supposed to have paid it quarterly. And again, they might not catch you, but if they do catch you, they can go back and charge you interest and penalty on the quarterly payments that you did not make.
Jill is asking, can you review the services that you provide to real estate professionals and how to reach you to engage your services?
I'm a real estate broker. I'm a local broker. I'm one of the local owners. I teach this class through the MLS 2-3 times a year. And that's basically how you can access me. I think I did send, I don't know, did we ever figure out how we could send the handouts of the list of deductions to participants? Maybe send me emails. I think my email was on the slides in the beginning. And
We can go ahead and send those out with, when we send out the slide, send out the links to the.
Oh, great, great. So then what's included in there is a couple of those sheets that a couple of different accountants have for how to track your expenses as a realtor for the year. And then a list of everything that you can deduct.
We have a question here. If you are between 65 and 69 years old, does it pay to still put money into a separate account to reduce income this year?
If it's going to reduce your income and the amount of tax you pay, absolutely. Because, once you're at 65 to 69, you can get that money back without any penalty, without any waiting period. So you put that money in and, you wait till you're in a lower tax bracket to take it out. It definitely is beneficial.
Okay. And Cheryl is asking if the PUA received was used on the business to create virtual marketing presence. Is that part of business income or only part of the individual tax return?
I'm sorry, PUA?
PUA. I don't know what that is.
I don't either.
Oh, okay. Cheryl, if you could let us know what that is. I thought maybe it was an accounting term. That's why I didn't know what it was.
If whatever it is what you.
Oh, here it is. Pandemic unemployment assistance. Thank you.
So you used it to create a virtual marketing presence. That part is.
So
you got money. So you received money from the government that's going to be counted as income towards you, and you use that in turn to create marketing. You spent it to improve your marketing presence. It absolutely becomes a deduction.
Okay. I think we're just about wrapped up.
Okay.
With the questions. I know we're gonna. It was very interesting, Maureen, and thank you so much. We really learned a lot here. And I'm going to throw it back to Cheryl. I'm sorry, Crystal. I had Cheryl on the line. Crystal to close it out for us today.
Sure.
Thank you so much, Maureen, for what you shared. I'm sure there are a lot of other agents in the audience, just like myself, who got a lot of value from the information that you shared. As stated, Maureen is one of our instructors, so please look out for her classes on our HDAR website and take part in the great education that we offer. Once again, thank you all for attending this year's virtual Members Day. We're definitely living in unprecedented times. Also, don't forget that we have part 2 of our annual Members Day with our Board of Directors meeting and awards that we'll be giving out tomorrow, as well as our keynote address that would take place at 10:30. So be sure to click on the link and register, and we hope to see you there.
Crystal, can I chime in just in case?
Okay.
And to stay on for the annual meeting right after that, because we want everybody to watch our keynote speaker, but then stay on for the annual meeting.
Thank you, Richard, for reminding us of that. All right. You'll see your great executive committee as well as others, Rich Haggerty, and also all of our agents that are receiving gifts this year, awards this year. We really want to recognize them, especially because this is such a different format. Being in the virtual world, it's our new normal. We don't know what the future is there to hold, but we're looking for encouragement and camaraderie into tomorrow's meeting as well. All right, so as we sign off, we ask you all to be safe. Any other things, Richard?
One last plug, and you may have already done it, Crystal, is we've got the HG Realtor Foundation is doing a drawing tomorrow of anybody who registers and pays for $20 to get a free membership for 2021. So we encourage you to go online at hdr.com and make your contribution.
Register for that raffle.
Register for the raffle to benefit the HG Realtor Foundation and to be eligible for a drawing of free dues for 2021.
All right. You know that expression, if it's free, it's for me, right? So, so put that $20 in because it goes to a great cause, our charitable portion of our organization. All right. Thank you so much, everyone, and be safe. Bye now.
Thank you.
Bye. Thanks.